Hi, everyone. Welcome back to the Valery Real Estate Masterclass. In the previous episode, we just finished covering buying versus renting your home and whether or not owning real estate is even the right financial decision for you. Now we're going to go a little bit further to understand your own finances before picking which direction to go. In this episode, we'll be covering how to save for a down payment while using every available tax-saving resource, what things might affect your ability to acquire financing or a mortgage, tips for monthly budgeting to ensure you meet your obligations, as well as any other tips and tricks that might be available to help you on your real estate journey. When it comes to buying a home, it's important to understand that this is a major financial decision. And so you need to understand your own finances before you even embark on anything in your real estate journey. We discussed in the previous segment some financial implications of home ownership, but there are various other things to consider. The first one would be understanding your personal finances. Are you confident with your income? Do you have enough income? Can you afford a house? Can you qualify for a mortgage? How can you, as a household or a family planning to purchase a home, collectively prepare your finances to make you a more compelling borrower or to make it easier for you to actually purchase a home? We're going to discuss one of the biggest hurdles in a real estate purchase, which is a down payment. And that's cash that you need to have on hand to be able to buy the home and qualify for a mortgage. Then we're going to talk about your personal financial situation, how much money you're able to save every month, how big of an emergency savings plan you have. So one of the first components of qualifying for a mortgage and being able to afford a home is having good credit. There are points on how to improve your credit score. The first one is to pay your bills on time. The second one is to keep your credit utilization under 30%. This is especially true for revolving types of credit like credit cards or lines of credit, which we're going to discuss a little bit later. There are a couple of different options to look up your credit score for free online. Head over to the Valery website and ask Valery, and she'll point you in the right direction. So we know that your credit score plays a crucial role in determining your eligibility for a mortgage and the interest rate that you're going to receive based on the risk that the lender perceives because of your score. So now we want to know what lenders actually consider to be a good score. Typically, a credit score between 660 to 724 is considered good. Then anywhere between 725 and 759 would be very good. And anything from 760 to 900 is excellent. I've actually never seen a 900 credit score before in my life. Those with credit scores below 660 will often struggle to get credit to qualify for better terms because lenders might see them as higher risk. And for that type of borrower, you'll often see them borrowing money from what we call a B lender or a non-bank financial institution. Nick's going to cover this exhaustively in the mortgage segment of this course, and he'll talk about the difference between A lenders and B lenders and even private lenders. The next piece we want to understand is who has this information, who gives you this score, who is it that's just out there constantly judging your financial decisions. So the credit bureaus in Canada are responsible for recording and reporting your credit, and those are Equifax and TransUnion. And as mentioned earlier, I'd highly encourage you to know what your credit score is, at least on an annual basis. There's a number of different resources that you can use to get an understanding for your own credit score. So I would encourage you to go over to the website and ask Valery how you can get access to a free copy of your credit report today. Once you've got your credit situation sorted out and you're confident that you're going to be going into your mortgage application with a good credit score, the next step would be meeting with a mortgage broker and assessing your financial situation and buying power. And we're going to expand on that later. A good friend of mine and co-host of the Canadian Real Estate Investor Podcast might be popping in to tell you a little bit more about mortgages because he's relatively more qualified to do so. So for the average Canadian homeowner or home purchaser, the mortgage accounts for anywhere from 50 to 95% of the purchase price. But the remainder has to come from something called a down payment. A down payment is cash that you put into the deal that is a good faith gesture to the bank that you're financially committed to the house. You have some skin in the game. And so if something goes wrong, if the home goes down in value, if you can't pay it, then they're in less of a loss position. And that process makes you a compelling borrower. They won't let you buy a house without putting some money into it. Saving for a down payment is a pretty significant part of buying a home. The amount that you save affects the mortgage amount that you need and can impact your interest rate. It's best to put a down payment of 20 to 35% to not expose yourself to too much leverage, although you can go as low as 5%. The higher the down payment, the less risk for the mortgage lender or the bank in this situation, and the lower interest rate that you can typically get on a conventional mortgage. Now, there is situations in which mortgages can be insured, and lenders will often offer lower rates for insured products because an insurer takes on a lot of the risk. There are 3 insurers for mortgages in Canada: CMHC, the Canada Mortgage and Housing Corporation; Saugin, which used to be Genworth and is owned by Brookfield; and Canada Guarantee, which is a third party, which is basically owned by the pension funds in Canada. We will discuss insured mortgages a little bit, but I typically recommend that you put a down payment of 20% or more on a property just to decrease your risk. As we know, Canadian real estate, especially Ontario real estate, can be exceptionally volatile. We've seen double-digit fluctuations in price upward and downward in multiple years: 2016, 2017, 2022. You want to build a little bit of padding for yourself and the lender so that you don't end up with any scary surprises on a mortgage renewal, given that mortgages have to renew every 5 years. One of the best tricks that I have to recommend to people for saving a down payment, beyond some of the government programs that are available, is when you're starting your home buying decision, pick a home that looks like it would be satisfactory to you and reverse engineer how much a monthly mortgage payment on that property would be. And then for a period of 1 to 5 years prior to actually going to get a mortgage and buy a home, save that amount of money. It'll prove to you whether or not you can actually service the mortgage payment that you're going to commit yourself to, and you'll be putting away a substantial amount of equity that you can use as a down payment towards that property. This is like signing up for a risk-free trial to see if you can even afford the home of your dreams. One of the great things about Canadian government savings programs is you can actually tax advantage the savings that I just mentioned. There's 3 different ways that you can do this as a Canadian. You can use the TFSA, tax-free savings account. You can use your RRSP, Registered Retirement Savings Plan, or you can use the FHSA, First Home Savings Account. The tax-free savings account, or TFSA, isn't tax deductible when you contribute to it. So you don't get a tax deduction for putting money into that account. However, any interest or earnings that you get on those savings through investing that money is not taxable. The next on the list is the RRSP, or Registered Retirement Savings Plan. Any money that you contribute to an RRSP is tax deductible against your income up to a certain limit, so it can help you reduce your tax obligation. Any earnings that you make on that capital that exists within your RRSP will be taxed when taken out of the RRSP at that tax bracket. However, there is one exception to this rule, and it's perfectly designed for people looking to purchase their first home. The Home Buyers Plan, or HBP, is a program that allows you to withdraw funds from your Registered Retirement Savings Plan, or RRSP, to buy or build a qualifying home for yourself or for a related person. The HBP allows you to pay back those funds over a 15-year timeline, which means that from the moment that you take those funds out of the account, you have 15 years to put those funds back into the account. Otherwise, you'll be subject to a penalty or tax obligation. Using this program, you can withdraw up to $35,000 from your RRSP tax-free to put towards the purchase of a first home. The final tax advantage program on the list is the newest program. It was introduced in 2022 by the federal government to help battle Canada's housing crisis. And the FHSA stands for a First Home Savings Account. It's a registered plan allowing you as a prospective first-time home buyer to save for your first home tax-free up to a certain limit. These accounts have been available to Canadians since January 1st of 2023. This new registered plan gives prospective first-time home buyers the ability to save up to a lifetime maximum of $40,000 on a tax-free basis. You can do this by depositing up to $8,000 per year for 5 years. Tax-free. So it would take you 5 years to maximize that total untaxable amount of $40,000. The interesting part about this program is it has the benefits of both the tax-free savings account and the RRSP, where that $8,000 deposit that you make on a per year basis is tax deductible against your income, and earnings that you make on that capital while it's within your account are also not taxable upon withdrawal, as long as those funds are used towards the purchase of your first home. It's worth noting that all of these programs can be combined because it's often more than one person who's purchasing a home. So if you and a partner want to go in on a home and you each want to use $40,000 from your FHSA and $35,000 from your RRSP, as well as any funds from your TFSA, you can both combine those funds to purchase a home. And by doing this, it allows you each tax advantages against your income and against your earned investments. And it allows you to combine for a pretty substantial down payment, given that house prices are accelerating pretty rapidly in Canada. The last piece we're going to cover is a little bit of a teaser for the mortgage course that we're going to get to later. And again, Nick is going to go through most of this stuff exhaustively and show you some calculations. But lenders assess your ability to handle mortgage payments by evaluating your gross debt service and total debt service ratios. These ratios consider your income and existing debts to determine affordability. We're going to go over this in much more depth in a later module. These debt to income ratios are based on government instituted housing affordability targets, which typically used to range around 30% of household income. But now the government has been gradually replacing that term of affordable housing with the term of attainable housing. And the percentage of household income that is spent on housing seems to be creeping a little bit closer towards 40%. So a lender will allow you a GDS ratio, or gross debt service ratio. This is the debt service that you're just using on housing related expenses, of 39% of your income. And they'll allow you a total debt service ratio. So just think total debts, add in your vehicle payment, maybe credit card payments. They'll allow that to go up to 44% of your annual income. Putting this into succinct terms, if you make a $100,000 after-tax combined household income, you should only be spending about $39,000 of that total income on things like mortgage payments, taxes, insurance, and they will also include maintenance expenses in that GDS ratio. The last thing we're going to go through here is mortgage insurance. And again, this is going to be elaborated on later, but we mentioned that you can buy a house with less than a 20% down payment, although honestly, typically not recommended. And I'm going to explain why. Mortgage insurance may be required if your down payment is less than 20% of the home's purchase price. This protects the lender in case of default, and it adds to your mortgage cost. So you as the borrower are the one who is paying for the insurance policy. So let's just use a quick math example. If you buy with 5% down, your mortgage insurance cost is 4%, and that cost is added to the principal of your mortgage. And so now, all of a sudden, you've put 5% into the house and you've had 4% taken out of the house by your insurance costs, and you're in a 1% equity position. This is before considering things like paying your land transfer tax on the way in and any costs associated with selling the home on the way out, which you'd have to pay a realtor, as well as some other costs associated with selling the home. So if you buy a house with 5% down, you're technically in a negative equity position as soon as you take possession of that house. That's not to say that this is completely financially debilitating. It's just that there is risk associated with it, and I want you to be informed of that risk because the Canadian real estate market has proven to be exceptionally volatile over the past 10 years. Okay, so hopefully by the end of this lesson, you have a good understanding of your own financial picture and the financial decisions that you need to make to be a homeowner and to make that homeownership decision safely. So we covered the different tax advantage programs that you can save your income that are available from the government of Canada. We covered how you can combine those and use it towards a down payment of a home. We also covered the personal trick that I use, which is to actually commit yourself to the mortgage payment that you'll have to pay in the future and use that as your method of saving for the period of time that you're saving up to buy a home. That way, when you actually take possession of a home, you're used to putting that much money away. We also covered your credit score and a couple of different tools that you can use to keep your credit score compelling so that you can qualify for a higher mortgage amount. And then finally, we looked at the different ratios that lenders look at when they're qualifying you for a mortgage. And a lot of this stuff is going to get expanded on in a future episode about the mortgage. Now, beyond your financial picture, you only have so much time to understand a lot of these things and especially understand the real estate market. So that's why in the next lesson, we're going to cover how to work with a real estate agent to create a competitive advantage for yourself in your home buying process.